Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Campbell and my goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Sorry to keep repeating, but just in case you missed it, Campbell and I are hosting our first live Q&A podcast session on YouTube. It's on Monday, 23rd of March, 8:30 p.m. So hopefully after the kids are to bed, everything's done, can sit down and listen to everything that Campbell has to say that's very interesting, and I'll just fill in the blank noise. You can register by going to investopoly.com.au/live. So investopoly.com.au/live. You can register for the event and we'll send you all the details. Now, today I would like to talk about something that I've called the forever test. And I think it's one principle that if investors really, truly, honestly grasp it, it'll help them make the smartest financial decisions for the long run. And I know that sounds like hyperbole, but I assure you, I cannot overstate how important this forever test is. And the idea that I got for this episode was really around or driven by all the rubbish I see, either clients that come to us, prospective clients that come to us, the decisions they've made, or seeing what other people in the industry, and when I say industry, it could be financial advisors, accountants, buyers agents, whatever it is, when you see what's going on, whether it's advertised on social media or you see it in real life by meeting these people, I think, my God, there is a lot of poor decision making that's going on. Well, I was going to say at the moment, but in reality, it's probably always been there. And I think it really just comes back to this one forever test. And again, if you really understand it, it will help you avoid making mistakes. It's not a get rich quick scheme. And the problem with investing in great investments is that literally 5-10 years can go by and you're better off, but you're not wildly better off. It's really what happens beyond that where the magic happens. So the forever test is, put simply, is buy investments with the strongest past evidence and fundamentals that suggest that this asset will deliver the highest expected long-term return between now and age 60, or even better, now and age 80. So let me just pull that apart. I'm 51 today. So if I'm buying an asset, my perfect time horizon to think about that asset is, say, the next 30 years. Say it takes me through to 80 years old. And what I want to do is mathematically buy the asset that has the highest average rate over the next 30 years. I'm not trying to work out what's going to do best over the next 5 years or next 2 years or next 12 months. Whether that's an ETF, a property, or whatever asset class we're dealing with, the thing is, what I want is the highest average returns over many decade periods. Now, when I've done that, I need to do two other things. I need to keep cost and tax drags as low as possible. So that is, I want to think about how does that investment behave from a taxation perspective and what are the costs associated with it. And essentially what I'm trying to do here is keep most of the return. Like, I don't want to leak much of my return in either costs, so fees that you pay to other people, or taxation consequences. So I want it to be tax efficient. And the second thing you need to do is choose something you can stick with, because that's the behavioral finance issues. Because a portfolio can be fantastic on paper, but it's worthless if it triggers poor decisions like selling at the wrong time, impatience, these sorts of decisions that can interrupt an otherwise great investment and great investment process. Now, you also want to think carefully about the time and the emotional energy involved in managing that investment as well. And I'm going to talk a little bit more, and I'll expand on these points during today's episode. But, there's some investments that are very hands-off, like buying an ETF is probably the simplest growth asset style investment you can ever make. Conversely, owning a residential property can at times be time consuming, particularly if you've got some maintenance requests, some tenant problems, some issues with the property. Like, I've got one at the moment where there's a construction next door. It's causing a bit of hassle. These things happen from time to time. They're not going to be persistent. They're not going to happen all the time, but they do happen from time to time. And we just need to be conscious of, how much time and energy and emotional energy do we have to contribute towards an investment, because we need to stick with that. It's a long-term commitment. We're marrying that investment for the next, in my case, the next 30 years, for instance. So that's the forever test. I've given you a sort of a broad overview. Now I want to get into the detail. The warning I have for you though is simple concepts are incredibly powerful, but it's very tempting to disregard simple concepts, as they're too simple, and I should do something just a little bit different, or yes, I know that's what's going to work, but if I'm a little impatient, I might just try this other way of doing things. So whilst concepts are simple, all I want to do is just, if you're of a mind to sort of think like that, like I just explained, maybe just suspend your disbelief for a little bit and just listen into today's episode, because as I said, if all investors adopt this forever test and applied it to their investment decisions, I can guarantee you a lot more people would have a lot more money. And, it's not get rich overnight, but it really will help you, in 20, 30 years' time, be in a substantially better financial position. Okay, so let's get into it. Let's first talk about time horizon, right? Because, we can speak to people and, they think that they should align their investment time horizon with their goal horizon. And sometimes that's not the right approach. You need to think about your goal horizon, as in, when do I want to have the flexibility to stop working, like have the choice to work as much as I want to work at any particular time? What is that age, or what is that date? That's an important consideration, and it may have influence over the types of investments that you invest in. But in reality, your investment horizon is much longer than that. Because let's take, for example, someone that wants to retire early, as in before they can access super, let's say 50. Now, you might think that if they're 30 today, they've got a 20-year investment horizon. Actually, that's not true, because really what we've got to think about is, if they're retiring at 50 and if they're 30 today, they have to plan as if they're going to live to 100, I think, with medical advances and better education, better, more proactive medical treatment, all these sorts of things. I think it would make sense to plan to live to 100. So really the decisions they're making between age 30 and age 50 need to really play out over the next 50 years, like the subsequent 50 years after they retire at 50. So that's where we can end up making a wrong decision in terms of time horizon, as in matching our investment time horizon to our goal time horizon. So when I'm advising a 30-year-old in that situation, I am definitely thinking about, okay, how do we fund retirement at 50? Like, how are we going to pay for living expenses? I'm definitely thinking about that. But I'm also thinking about, well, if I'm too focused on that, then I risk running out of money, because we're going to start eating into our asset base at age 50, and we might need that asset base to last 50 years. So I really need to think about, okay, my decisions today, how they play out in that person's 60s, 70s, 80s. I need to think about those sorts of things. And this is where compounding capital growth comes in. Albert Einstein is often credited with the saying, compound interest is the eighth wonder of the world. Those who understand it earn it, and those who do not pay it. But here's the catch. The challenge with compounding capital growth is it's basically meaningless over the first 10 to 15 years of your investment journey. And you must largely take compounding capital growth on faith and basic maths rather than evidence or observation. Because by the time people get convinced around compounding capital growth, it can sometimes be too late. Now, a common example that's often cited is that Warren Buffett has accumulated somewhere between 95, 97, 98% of his wealth after age 65. So he's been a wonderful investor for much longer than that. But when we look at the impact of compounding capital growth, that really brings it home to roost. In fact, I was having a conversation with a client last week, and he's investing a substantial amount every month into the share market. And the portfolio's done really well, double-digit returns. So there's no problems there. But all the impact in terms of what's contributed to the value is mostly his contributions. Even though the portfolio's returned well, it's mostly driven by his contributions. That's why his ability to save has put him in a great position. But if we have that conversation, if I have the same conversation in 10 years' time, it's going to be completely different. That the growth and the income coming off that portfolio mathematically, even if it doesn't perform that well, will be much, much more than that individual's contributions towards it. And that's what I'm saying. Now, that's a 10-year period because he's investing so much. But if you're not investing as much, then it might take 15 or 20 years for that to happen. But that's precisely how compounding works, right? So you shouldn't expect massive changes in that first decade. It's not linear. it's exponential. It starts quietly and then becomes absurd, really. I mean, the numbers are a little bit crazy, but whether you experience those crazy numbers really come back to that investment decision that you made right at the beginning. So let me demonstrate this with just a few basic numbers. Let's say you invest $500,000 in the share market and you experience over the next 40 years an average return of 10%. If you have a look at the average return in most share markets, whether it's the Australian share market, a global index, the S&P 500 in the US, if you look at some of the European like StockX indexes or whatever, it's all about the same over that 40-year period. So I'm using a realistic, if we look at the evidence, a realistic assumption here. So $500,000 into the share market. Over the first 10 years, that portfolio, if all the returns are reinvested, excluding any taxes, let's put taxes and costs aside, will grow by $800,000. So about $80,000 a year. In the second decade, year 11 to 20, it'll grow by $2 million. So really $200,000 a year. Pretty good. That will pay for most people's living expenses. In the third decade, year 21 to 30, $5 million. So over $500,000 a year it'll grow by. And in the fourth decade, year 31 to 40, it'll grow by $14 million. So $1.4 million a year. Do you think you can live on $1.4 million a year? Well, all you need to do is find $500,000 and wait 40 years. Of course, I'm being facetious, but it's a really simple example how compounding capital growth is not linear and it is exponential. And after more than 20 years, when you get into that third and fourth decade, the numbers start to become stupid. And that's why if I go back to the retire early scenario where someone wants to retire at 50, that's why it's important to add weight to the decision making in terms of what assets do I need to invest in today so I can pay for living expenses when I'm in my 50s. But also it's important to add probably just as much weight, if not more, to how can, what investment decisions can I make so that I include compounding or the benefit of compounding capital growth so that this person, even though they're eating into their capital base and asset base from age 50, that they're not going to run out of money. And that's why understanding how compounding works matters today, because today time is still on your side. You don't want to, the sooner you learn this lesson, I think, as an investor, the more you can take advantage of it. And that's why investment selection is really fundamentally a multi-decade long decision. So you should assume when you buy an ETF, a property, or any other asset, you should buy one that you're happy to hold for many decades and that you think possesses the fundamentals to drive the returns that you're looking for. So if the average market return is 10%, well, let's be conservative and aim for 8%. Let's choose an ETF that is robust enough in terms of its construction that we're confident, given our entry point, that over the next 30, 40, 50 years, our average return on average will be 8%. Never straight line. Of course, there's going to be volatility. There's going to be bumps in the road, but 8% is kind of what we're aiming for. Remember, Warren Buffett stated his favorite holding period was forever, and hence you can understand why I've called today's episode the Forever Test. Now, the challenge with this approach, of course, is that it requires a little bit of delayed gratification, or maybe a lot of delayed gratification, because what I'm saying to you is if you make a perfectly sound investment decision, you're not necessarily going to move the dial that much over the next decade. And therein lies the delayed gratification. But it's really understanding the maths and making sure that you make that decision so you don't look back in 10 years' time or even 20 years' time and go, well, that didn't really work out how I expected. If I just had bought this asset or this property I was thinking about buying, look how much it's worth today. And remember, your goal isn't to beat returns or achieve the best return over the next 1, 2, 3, 4, 5 years, 7 years. There's going to be other assets within that asset class that will do better over the next 5 years. That's okay. You can make friends with that. If I'm going to select a property and I think this property is investment grade, I make friends with the fact that there's going to be a lot of other property in other locations that are going to do better over the next 5 years. That's neither here nor there. It's like awarding a winner at quarter time in a football match. It's neither here nor there. What I'm really worried about is what is the average return, as I said, over that multi-decade period. Okay, next part, let's talk about reducing the cost and tax drag, because this is an asset selection principle. So this really needs to be considered at the beginning when you first buy this asset, and we need to understand how this cost drag really can work against you as a headwind against compounding capital growth. Now, if we're going to talk about the share market, a lot of listeners today are investing in ETFs, and well done, they're fantastic products. Okay, as long as the index, I'm happy to hold forever. So of course there's a lot of thematic investing out there, shiny objects. If you're not looking to hold it forever, then they don't really fit the mold. But the diversified index funds or broad-based indexes or some factor approaches, for instance, they've been around for many decades and they're fundamentally sound. They're the sort of thing that you can buy and hold forever. And so if you're doing that through an ETF version, for instance, as a result, your fees are going to be low. So if you're taking that approach, you probably don't need to matter or worry about fees too much. But sometimes sometimes investors can be too focused on fees, and you can be too focused on fees. In a portfolio, you're going to have some ETFs that have incredibly low fees, and then you're going to have some ETFs that have higher fees. And if you construct a portfolio, so to give you a sort of indication here, our portfolios that we construct tend to have a weighted average fee of around about 0.3%. So it's still really low, but it's made up of some funds with very low fees, maybe 0.04% or maybe even cheaper than that. And there's going to be some ETFs that charge maybe 0.7%. Now, our goal is to maximize long-term returns net of fees, right? So if we're paying 0.7% for a particular ETF, we're doing it because we think the methodology is superior or the asset class is more expensive to get exposure to. And we're comfortable that the likelihood of earning way more than the fee, so to offset the fee in terms of higher earnings, we've got a high likelihood, a high confidence level that that's going to be the case. So if you don't employ that approach, what you do, if you're too focused on fees, you'll actually let fees drive the portfolio construction and the index selection. And that's not the correct approach. What the correct approach should be is to let the fundamentals and the analysis of the market and what you're looking to do in your portfolio drive the selection of the ETFs that you're going to choose. And then secondary to that, you consider the fees and consider whether that's appropriate. So you need to do it in that order, not the other way around. Now, if we're talking about direct property, so investing in property as opposed to the share market, controlling costs is a little bit more challenging, okay, because you're mostly a price taker in many of these categories. The key categories where you can pay a little bit of attention to is property management and insurance premiums. Of course, shop insurance premiums around, but they never go down, they always go up. So in terms of controlling, rising costs, there's probably not much you can do there other than shop around. Property management fees, you can shop around on property management fees, but be careful because you're probably going to get what you pay for, and they're looking after a very valuable asset. And actually, I just took part in a panel discussion and there's a property manager there, and they were talking about being more proactive with property management. So instead of waiting for a maintenance request, sometimes we can be reactionary as investors, as landlords, and so sometimes it's better to understand what's caused this issue and maybe I'm better off. So I'll give you an example. In one of my properties, there's a ceiling that's sagging. The plaster's just getting old, I think, and it's sagging. It could be old plaster, whatever it is. And this is yesterday, I got a request to repair that, and they were just going to re-screw it in and patch and paint. But, let's think about whether we just re-screw in, crappy plaster that issue's going to reoccur again maybe in a couple of years. What's the cost just to replaster the ceiling? So sometimes we can be too cost focused. Of course, we want to look at value for money, long-term value for money, and also looking after our assets and making sure we enhance the value. But so yes, you can look at property management, but just be careful about choosing that based on fee. Remember, fees are what you pay, value is what you receive, and you want to think about what value are you receiving relative to the fee you're paying. Okay, next bit, because we're getting bogged down. Of course, interest rate. Interest is going to be your biggest cost. So the interest relative to that relates to the mortgage that you use to buy that property. So of course, minimizing interest rates as much as possible. I mean, you get nothing extra for paying more, except some lenders might have a higher borrowing capacity, and so that might justify using that lender at that particular time. But once you've got that debt, whether you're paying 5% or 5.5%, you're not getting any more or less for it. So you may as well just, in terms of value, so you may as well shop on price. And just be critical around maintenance requests as well. I forgot to mention this, that of course, sometimes, property managers, they're looking after 120, 130 properties. So, you're getting, you're competing for time, and it's a difficult job. It's probably the hardest job in the property industry to do. So just be critical. Like if you get a maintenance request, I remember many years ago, I got one to fix a front gate, $2,000 or something. It was just an old Victorian house and it had a wooden front gate. I mean, you're not going to pay $2,000 for that. So just be careful around that cost drag there. On the tax side, we want to think really carefully about taxation consequences, because our returns, our gross investment returns, can leak through tax liabilities, of course. So there's a couple of tips here, a couple of observations in order to help you do that. The first one is ownership structure. You need to get it right from day one. And so actually the common theme in this forever test, there's a lot of important decisions that you make when you first purchase an investment, be it an ETF or a property, that have very long-term impacts. So this is why it's so important, because once people realize, the fundamentals behind the forever test, sometimes it's too late to unwind what you've done over the last 15 years. You can make money back, but you'll never get that 15 years back. And time is a very important ingredient. Anyway, let's get back to tax, Stuart. You're moving off to the side now. So how you own an asset, of course, is going to determine, the taxable income or deductions that you might get, negative gearing benefits, of course. If you ever go and sell that asset, what capital gains tax you're going to pay. And if you get it wrong, fixing it can be really costly. There might be CGT involved, and if there's property, there's going to be stamp duty. So it tends to be cost prohibitive to change the ownership structure of property. Almost, I can't remember one where I think we've looked at it, and it might be a handful, but there's very, very rare. So once you put an asset in a particular ownership structure, you really got to live with that ownership structure for the rest of the time you own that asset. And the second element is it's great to look at gross returns, but what you want to do is look at the components of those returns. So am I getting 10%? That's fantastic. But if all that 10% is coming to me in terms of distributions and income, either through income or realized capital gains, then I'm going to pay tax on that every year. And if I'm on the highest marginal tax rate, it means half of my returns are leaking to the government. So that's tax inefficient. What you really want is almost 99% of your return in capital gains, unrealized capital gains, because the benefit of that is there's a compounding benefit that, yes, I have a unrealized tax liability, as in I've got an inherent liability attached to this asset if I ever go and sell it. But the kicker is I don't need to pay that liability until I sell it. So I get to reinvest my return pre-tax and then delay paying the tax, hopefully for many decades. So choose assets that are going to give you more growth on average over the next 20, 30, 40 years, and hopefully as little income as possible. So I was just looking at the data across our share portfolios where we do regular monthly investing for clients. I think the time horizon's about sort of 4 years, over the last 4 years, the report I was looking at. The compounding return annualized return was like 13%, I think, and it consisted of 12% growth and 1% income. So it's an indication or an example, probably, of a perfect split between income and capital growth. That's a very tax efficient portfolio. So you might recall back in February, Campbell recorded an episode that looked at how much we invest in the Australian share market versus international share markets. And he made a case for, at least at this stage, investing more in the international share market. That was episode 397, if you want to go back and look at that. But it's a good example, and it fits into this forever strategy, because international shares are going to give you, or let me put it this way, if we look over the last 10, 20, 30, 40 years, international shares have given you a lot more growth and very little income, whereas Australian shares, and Campbell mentions this in the episode, Australian shares actually give you too much income. It's a little bit lower at the moment just because we've seen some growth, but for a long time it's been like 50-50. And so there's a natural tax drag if we're investing a lot in Australian shares because they generate so much income. Similarly with bank stocks, for example, a lot of people go, I've owned bank stocks for a long time, and they've done really well, but they pay out a lot in terms of dividend yields. So again, they're tax inefficient. Unless your ownership structure, of course, is inside super, for instance, in pension phase, then you don't really need to worry about it. Okay, the final component of the forever test is how much time and emotional energy it takes to manage the investment. And this is something you really need to think clearly about, because I find that younger people, this is less of an issue for. Maybe they've got a little bit more time on their hands, or they've got a little bit more energy. But as people get older, and certainly as they get into retirement, their capacity and willingness to deal with investment decisions and decisions relating to investment assets is diminishes. Like it starts to become a bit of a drag on them, to be honest. So the key thing to really think about is how much time does this asset take to manage? What's the number of decisions I need to make on an annual basis, for instance? Because sort of one is about time and then one is about distraction and emotional energy. Remember, one of your goals is to make your money work harder than you do. And simplicity in your investment structure and asset selection will help you do that. Simplicity means that there's going to be very little time involved in making decisions and managing those assets, which means you're more likely to stick with them for long term, which means you're more likely then to enjoy the benefits of compounding capital growth. Now, a portfolio of ETFs can largely be set and forget. I mean, once you choose a strategy, of course, you need to keep asking yourself, is this strategy still fundamentally correct? But if you got the decision right from the outset, the chances are every single year you look at it or a couple of years, your answer is going to be yes, and it's fine. So resist the temptation to make changes. Some strategies, indexing strategies, are going to underperform in different market conditions. Again, we don't expect that returns are going to be received on a straight line basis. It's fine. It's not to say that are the returns meeting your benchmark? Are you happy to own that index for the next 30 years? So ETFs tend to be pretty easy to manage. It's property that can be more difficult. Now, I think that I'm not trying to dissuade people from investing in property, nor say it's a big negative. I don't want to overplay it, okay? Because the reality is you're going to have periods of time where you own property and there's nothing to do. Like you won't hear from the property managers, the money comes into your account, the rent comes into your account every month, happy days. But also there are times where it can become more intensive, particularly over the last few years. There's been a lot of changes in rental laws and tenancy laws, and that's necessitated then a lot of changes in property management and their approach. So I think over the last 5 years, there's been a lot more changes than, say, the previous 15 years. And so again, I don't want to overplay it because those changes will eventually settle down and we'll get used to them and it'll be normal again, but they can take time. And particularly if you have a particular incident or issue going on with your property, it can take a lot of time for a short period of time, maybe a couple of months or something like that. But we've got to understand this emotional energy also associated with making these small decisions. They might be not big decisions that move the dial, but it might be just constantly, I need to decide on this, I need to do that. And it can be laborious because we're not expert property managers. So sometimes we feel like, well, I think this is the right decision, but I'm not really sure. And that's why it takes emotional energy, because a simple question like, what do you want for lunch, is a simple, easy answer. But should we do this repair or do something more extensive, you've really got to, apply your mind to it. So again, I don't want to overplay it or talk anyone out of investing in direct property, but you have to, I think, at the outset, make friends with, if you're going to invest in property, make friends with, there's going to be periods of time where this property is just going to be a pain in the neck. And there's going to be times when I'm going to regret owning this property. But on average, over the next 30 years, the time required to manage it won't be too bad, and the results will be excellent. Hopefully, at least that's what I'm aiming for. And I'm quite happy to contribute that time. Once you make that commitment, you've got to really, as I said, you're marrying those assets, you're with them for life. Okay, so how do we apply the forever test to property and how do we apply it to share investing? Well, with property investing, it's challenging because a lot of the commentary and noise that you see is very short term. Prices this quarter, auction clearance rates last weekend. What will the RBA do next month? These are all very short term data points. They're all noise. They're not helpful in making long term investment decisions. Ultimately, what you want, property is good. Investment grade quality property is good in that it delivers most of its return in capital growth rather than income. So its tax is efficient in that way and you get some negative gearing benefits, at least you do for now. Let's see if they change that. But the whole thing is you want an asset that has the fundamentals to really drive growth. So that is, it needs to be constrained supply of that type of asset and excessive and stable and robust demand. If you have those fundamentals, then mathematically it's going to generate a lot of growth, a lot of value, a lot of wealth for you over the next 20 or 30 or 40 years. Now, that's been challenging, particularly over the last couple of years, where there's been locations that aren't fundamentally sound that have outperformed. So, more regional style locations, lower quartile value property that tends to be located, in outer suburbs where there's an abundant supply of vacant land. These markets have been doing better than, investment grade blue chip suburb. Although I've got an episode for you in a couple of weeks' time that will actually disabuse that notion and present, Melbourne investment grade property that actually has done pretty well to show you that property can outperform. But anyway, we'll get there. So sometimes it's difficult. What I'm saying is to focus on the fundamentals because all the noise and all the short-term data is saying that that's not where the growth will be. But it really just comes back to basic fundamentals, basic maths, basic logic. Invest in a location that higher income earners want to and higher, more wealthy people, the top 20% of wealthy Australians want to live in that location where supply is fixed and finite and demand is diversified in terms of there's a lot of different buyer types, whether they're downgraders, upgraders, families, investors. It's very diversified. That's going to underpin that demand for many decades. When looking at ETFs and investing in shares, to my mind, the best way to build an ETF portfolio is choose the indexes that are fundamentally sound, that you'd be comfortable owning for the rest of your life, and then buy them when they're relatively cheap, when the index is relatively cheap. And if you do that, I think three things are going to work for you. Firstly, the odds are stacked in your favor because your entry point is low. So by paying a sensible price or even a cheap price for a particular index, you're reducing your portfolio risk. Second, it increases the probability that your medium-term returns will be above average just because markets tend to revert to the mean. So if I'm buying something that's cheap, over the next 5 to 10 years, it's probably going to rise to its fair value. So that gives you some tailwinds in the early years in terms of returns. And third, it gives you a robust long-term foundation because the index is fundamentally sound. So you'd be happy to hold it for the next 30 decades. And assuming that you've considered the tax drag so that it's going to generate most of its return in capital growth, your entry point's great, your medium-term returns are going to be, probably above average. And notwithstanding that, you've got a great foot in the market that you can hold over the next 10, 20, 30 years. Now, I just want to relate the forever rule to a sort of current trend or a popular trend at the moment because it's funny, it's a little bit like fashion. Everything, something that is fashionable today will be unfashionable next year, and in 10 years' time, it's fashionable again. It all moves in cycles, of course. So when I started Pro Solution back in 2002, buying units or apartments in Townsville was a really hot strategy. And funny enough, it's been a relatively hot strategy over the last couple of years as well. So you wait long enough, as I said, everything comes back in fashion. And the initial hook back in 2002, 2003 was these things are yielding quite high rental yields, so they're close to positive cash flow. They're not costing you too much money. And because there was substantial investor demand, it ended up pushing up prices. Now, obviously, then market value yield started to compress as a result of that, which is fine. But your entry yield is kind of what you live with anyway, in terms of if you buy an apartment and it's renting for $400 a week, it's always going to be $400 a week. That's your price point. Doesn't really matter what the yield is. It really matters what the actual cash flow is. As I said, over the last few years, certainly Townsville's gone through a lot of growth and particularly those sorts of style of investments. So let's have a look how a forever investor would have done. So back in 2003, a 2-bedroom units was selling for roughly around $140,000, $170,000. Today, those similar properties are $450,000 to $500,000. So that 23-year period ends up being about a 5% compounding capital growth rate. And I would say inflation over that time has probably been about 2.5%. So it's about 2.5% in terms of real growth rate. It's not terrible. You're not going to be really upset by that, but it's not great. Now, the problem is there's been 2 growth cycles in that 23-year period. There's been that couple of years in 2000 and 2003, and a couple of years more recently. But the gap in between, not a lot happened. There hasn't been a lot of growth between, say, 2003 and, say, 2023. And I picked this example. There's lots of them, but it's a really good example that short-term returns never create long-term value. There's always shiny objects, someone dangle a carrot, all that sort of stuff. Sometimes you see it on social media. I bought this property 3 years ago and this is what the growth is. It's hard to argue that, that's a bad story. Of course, there's some growth there. But the reality is short-term returns never create long-term value. So when I see something like that, I go, okay, you're off to a good start, but what's the next decision? Because if you hold that asset for the next 20 years, you're going to be worse off. Like it's actually not going to work for you. It's not, well, at least it's not going to do as much as it could have. Whereas if you had have invested in Brisbane, well, really Brisbane, Sydney or Melbourne back in 2002, 2003 instead of Townsville, albeit the price point's higher, I acknowledge that, you're going to be in a completely different equity position than what that long-term Townsville investor will be. And that's why I like the forever test. And remember, the forever test is I want an asset that has the strong fundamentals that are going to deliver the highest average return over the next 30 or 40 years. I then want to consider the cost and tax drag. And then I want to choose assets that are going to be easy to manage because it's less emotional energy and less time, which means I'm more likely to stick with it for long term. The forever test is not exciting. The investments that you choose will not be exciting. The impact over the first decade's probably not going to be that exciting, but they will work. And what will be exciting is when you retire, when you meet your goal and you've got assets that are compounding substantially to the point where you feel like you've got this forever portfolio, perpetual portfolio, where, you never need to worry about running out of money. I have gone way over time today. I apologize for that, but it is a really important concept and I wanted to give it the time it deserves. Remember, just before I go, Campbell are doing a live podcast episode, Q&A, interactive, 23rd of March, 8:30. Go to investopoly.com.au/live. Link is in the show notes to register. And until next week, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.